Journal entry and general ledger are both vital components of accounting, but they serve different purposes. A journal entry is the first step in recording financial transactions, capturing information such as the date, accounts involved, and transaction details. It is like a diary that records the daily transactions of a business. The purpose of a journal entry is to maintain a chronological record of transactions before they are transferred to the general ledger. The general ledger, on the other hand, is a master record that contains all the accounts and their balances. It consolidates the information from the journal entries for each account, providing a snapshot of the financial health of the business. The general ledger is organized using a chart of accounts, which categorizes accounts by type, such as assets, liabilities, equity, revenue, and expenses. Journal entries are posted to the specific accounts in the general ledger, updating the balances for each account. While a journal entry captures individual transactions, the general ledger summarizes and presents the overall financial picture of a business. The general ledger is used to prepare financial statements and reports, providing information for decision-making and analysis. Modifying a journal entry affects only that entry, while modifying the general ledger impacts multiple accounts and their balances. In terms of structure, a journal entry includes debit and credit columns for each account, while the general ledger presents the account name, balance, and transaction history. The general ledger is often accessed more frequently than journal entries, as it provides a comprehensive view of the financial data. To summarize, journal entries capture individual transactions, while the general ledger consolidates and presents the financial information for analysis and reporting.